Welcome to the Morning Download Podcast, your go-to resource for personal finance, economics, and market insights. In just 8 minutes a day, we provide valuable information to help you make better money decisions.
Hey there, investors. It's time to buckle up and take a closer look at your portfolio today. Things are shifting, and this quarter might not be as rosy as we hoped. With big companies about to release their earnings reports, we have some advice for you. Play it safe. Now, here's a fun fact for you. The S&P 500 isn't as straightforward as it seems. Yes, it's called the S&P 500, but it actually tracks more than 500 stocks. How does that work? Well, it includes 505 stocks because some of its constituent companies have multiple classes of shares. Take Alphabet, for instance. You've got Alphabet Class C, GOOG, and Alphabet Class A, GOOGL stocks, both of which are part of the S&P 500 index. So why should you be cautious with your investments? Well, as these big companies unveil their earnings, it's important to stick with names you trust. Avoid venturing out into the unknown, as this quarter may throw some curveballs. These days, strikes seem to be happening everywhere. From the US to the UK to Australia, countries all over the world have experienced major strikes in recent months. And unfortunately, things aren't looking up for the US healthcare industry either. When it comes to strikes, the US has been leading the way. There have already been over 30 strikes in the country, both big and small. Some notable examples include the United Auto Workers strike and the Writers Guild of America strike. Workers are not afraid to go on strike if it means getting better contracts. Interestingly, the public actually supports these strikes, but with one condition. They don't want their own lives to be impacted. According to statistics, about 43% of Americans want unions to have more power. This is a significant increase from a 2009 survey following the Great Recession, where only 25% supported unions. It seems that unions have proven themselves successful in recent times, as 61% of Americans believe they helped the U.S. economy. Moving on to global news, the head of OPEC has issued a warning about a dangerous lack of investment in oil. This is definitely something to keep an eye on. On a different note, the demand for diamonds is falling as people choose to spend more on food and travel instead. Lastly, China is expressing a desire for more oil and copper, which has implications for global markets. So, that's the latest on the economy and news. Strikes are a hot topic, and it's interesting to see the public's support for unions. Plus, we should be aware of the warnings from OPEC and the changing trends in the diamond market. And of course, China's growing appetite for oil and copper is something to keep in mind. Stay informed and stay curious. So it seems like Tesla is facing a bit of a problem. They recently released their third quarter vehicle production and delivery numbers, and let's just say they're not exactly impressive. During this period, the company reported 435,000 deliveries, which is a 7% drop from the previous quarter's 466,000 deliveries. And to make matters worse, this number also falls short of the estimated figure of 461,000. Now, Tesla is still hopeful that they can achieve their target of selling 1.8 million vehicles by the end of the year. However, there are some obstacles in their way. To reach their goal, they'll have to increase sales by about 9% in the last quarter, which is definitely not an easy task. But wait, there's more trouble. Production also took a hit due to plant shutdowns. In fact, the company delivered more vehicles than it actually produced. All of these challenges seem to be reflected in the stock market as well. Tesla's stock has been quite volatile, opening in the red at $244.81 and briefly turning green at $254.28. To add to the concerns, the Russell 2000, which is a benchmark for small-cap stocks, has turned negative for the year. So things aren't looking too great for Tesla right now, but let's see if they can turn things around in the coming months. Interesting crypto news today, especially if you live in Singapore. Coinbase is making moves and expanding its reach to Singapore. They've just secured a full operating license from the Monetary Authority of Singapore, MAS. This means they can now offer their services to both institutions and individuals in the country. It's a big deal for Coinbase, and it's no surprise that Coinbase has its eyes on Singapore. There's a massive interest in cryptocurrencies there, and they want to capitalize on it. In fact, last year they received the In Principle Approval, IPA, showing their commitment to this market. Coinbase has already introduced some user-friendly services in Singapore, such as fast bank transfers, Pay Now, and integration with SingPass, Singapore's trusted digital identity system. They're really trying to make cryptocurrency accessible and convenient for everyone. But let's not get too carried away with the good news. While Bitcoin did surge over $28,000, analysts aren't entirely confident about its sustainability. In fact, BTC later retreated and ended the day slightly down. So, it's important to keep an eye on the market and stay informed. Nevertheless, with Coinbase's new license in Singapore, it's clear they're serious about expanding their global presence and making cryptocurrency more accessible to people all over the world. Exciting times ahead. Investing can be quite thrilling, with all the potential for big gains and losses. But did you know that being patient is actually the key to achieving the best returns? Yeah, it's true. In fact, those who resist getting caught up in their emotions tend to come out on top. Unfortunately, patience isn't always easy to come by, which is why we see so many people trading impulsively and losing money in the process. Here are a couple of tips to help you become a more patient investor. First off, always keep the long term in mind. Sure, the stock market may be a wild roller coaster ride in the short term, but over the long haul, it has consistently trended upwards. By focusing on the big picture, you'll be less discouraged by those pesky short-term fluctuations. Trust me on this one. Another important thing is to resist the urge to constantly check your investments. It's tempting, I know, but checking them obsessively can lead to anxiety and impulsive decision-making. Instead, set a schedule for yourself. Maybe check them once a month or once a quarter. It'll save you from unnecessary stress. Let's talk numbers. When it comes to selling a house, wait at least 5 years. That's the average time it takes to recoup your initial costs and start making a profit. Of course, there are exceptions, like for those skilled flippers who snag a good deal and renovate before selling. And if you're into stocks, consider keeping them for at least 2 years. But hey, if you're serious about making some serious dough, holding on to them even longer might be your best bet. Set a price target and sell only when you reach it, or when you're confident that the price is about to take a nosedive. Being patient is tough. Most investors want quick results, but if your goal is long-term success, you've got to embrace the virtue of patience. Trust me, it'll be worth it in the end. Here's a personal finance quote to kick off your day. Investors should be skeptical of history-based models. Warren Buffett, the legendary investor, has some wise words for us. He's not a fan of these models constructed by what he calls a nerdy-sounding priesthood. You know, those people who throw around fancy terms like beta, gamma, sigma, and whatnot. These models can seem impressive at first glance, but Warren Buffett reminds us not to be too easily swayed. Why? Well, he believes that too often, investors forget to dig deeper and question the assumptions behind these models. You see, it's not enough to just rely on some complex formula or fancy math. Buffett cautions us to be aware of those geeks who come bearing formulas. Instead, he encourages us to have a critical mindset and conduct our own analysis. Look beyond the surface and understand the underlying assumptions. Sure, history can provide insights, but it's not the be-all and end-all. We need to be cautious and not blindly follow any kind of investment strategy. So the key takeaway here is to be skeptical and do your due diligence. History-based models may appear impressive, but as Buffett advises, beware of those geeks bearing formulas.
In this episode, we covered caution for investors, global strikes, Tesla's delivery challenges, Coinbase's new operating license in Singapore, the importance of patience in investment returns, and Warren Buffett's advice on being skeptical of history-based models. Thanks for tuning into the Morning Download, your go-to podcast for personal finance, economics, and market insights in just 8 minutes a day. Don't forget to subscribe for more helpful content and sign up for our free newsletter at morningdownload.com/subscribe.